Howdy, Jacob here. Today we're looking at ticker symbol AQN in the utilities industry. Again, like I said in my last video, I redid the stock screener because I haven't done it since October, and so I added 18 companies to look at. So we still have 18 more companies to look at before we get to our next screener. So multi-utilities industry on 11.9 billion enterprise value, 4.2 billion market cap. So a lot of enterprise value, a lot of debt here on 7.1% dividend yield. We're looking like the revenue is looking 634 million in 2013 up to 2.7 billion in 2022. So quite a bit of growth here. And their margins are actually both expanding, 15.3% operating margin to 18.1% in 2022. And then 2013 gross margin of 59.7% up to 68.7%. Return on invested capital is low single digits, averaging about 2%, 2.5%. Nothing to brag home about. Looks like they own and operate hydroelectric, wind, solar, renewable natural gas, and thermal facilities in Canada. Okay, let's look at some of that debt. It looks atrocious to me. $7 billion long-term debt, almost 10 times what they had in 2012, and cash and cash equivalent, 58 million. So they're with 423 million in short-term debt. So liquidity side on the balance sheet, very disgusting in comparison to debt, and cash flow. Also a terrible story. They have not produced positive free cash flow since 2019 when they produced $30 million. All right. So again, two ways to fund a business that cannot sustain itself through positive free cash flow: issuing shares, issuing debt. And we see that they've done both. Huge increase in shares, huge increase in debt, which we can also see on the balance sheet for debt. 774 million in 2012 to 7.1 billion. And then on the share side, 204, I believe that's in millions, shares outstanding in 2013 up to 678 million in 2022. So this company absolutely cannot afford this dividend of 352 million aggregate payout, and they can't afford to make these acquisitions, and so they're just issuing debt and issuing shares to fund these projects that they can't afford. Places where I get very frustrated. 7% yield is fake. All right, so quick video. I'm just going to do some quick assumptions here. Growth looks fantastic. If they keep doing what they're doing, they'll probably have fantastic growth. 5% growth assumption, 16 for 7 years from now. PE, price free cash flow. Margin, 10% free cash flow. They don't do it, but let's just do something anyways. Or let's say 3%, 5% share change since they've increased more than 5%. And dividend, they can't afford it. Cut it 80%. And again, they still can't afford that, but whatever. Future stock price needs to fall 69% given these assumptions. Again, to me, a company that I want to own has free cash flow. Especially on the dividend side, I want a couple things. I want very positive free cash flow in comparison to their dividend, meaning their payout ratio is low relatively. It depends on, are they a growing, what are the uses of cash that they have? If it's a non-growing company, I'm fine if it's as high as 70%, maybe even 80% if it's as consistent. If the company's extremely consistent, maybe they're buying back shares to where the dividend doesn't go up, but the aggregate goes down due to share repurchases. And then I want a healthy balance sheet. And this company does not produce positive free cash flow, at least consistently. They haven't produced positive free cash flow in 3 years. And then their balance sheet has no liquidity to pay a dividend if worse comes to worse and they don't produce positive free cash flow. They can use cash on hand to support it. But they have so much debt that they're unable to fund any sort of dividend that they have. They just have to issue shares and issue debt to do so. And there's going to be a time where the lender comes and says, I want my money back. And they're not going to have it. And so they're going to have to sell off a lot of property, which will hit their revenue because they're going to have to sell off part of their assets. It'll just hinder all their growth opportunities. So to leverage your growth can be good up to a point. But when you over leverage and the lender comes to you and you don't have the assets, you don't have the money to to handle the business, then you're going to be in a sticky situation. And so to me, this company, Ixnay, it's just not there for me. So thanks.